Do you know 90% of people lose money trading the financial markets and 80% of people quit within the first 2 years? And it's all down to one thing: hope. Hope is a false belief that you can bend the market to your will. By the end of this video, I'm going to show you how you can replace hope with practical advice and strategies so you can avoid being the 90% and stay in the market longer than 2 years. This is the Mind Mastery series where we look at trading psychology, where we break down emotions and mindset so you can become successful in the financial markets. We spoke about patience, greed, fear, anger, and now we're going to be talking about arguably the biggest culprit, arguably one of the biggest things that stops people becoming successful in the markets, and that is hope. We're going to break this down nice and easy so you can understand how to control hope and how you can be successful. Number one, the first thing that you must understand is that hope does not change the markets. Hope is wishful thinking, and wishful thinking might be good in other areas of life. Wishful thinking maybe in the pursuit of something in sport or a career, but guess what? Wishful thinking does not work in the markets at all. In actual fact, wishful thinking is the last thing that you should be using. Why? Because the market holds no bias, the market holds no feelings, the market will do what the market wants to do. So what am I trying to say? Most people, when they enter the financial markets, when they start trading, when they buy a stock, they buy it on hope. Why? Because they think it's quick money. And when you do something with quick money, you often don't put work in. And if you don't put work in, you don't have a strategy, meaning that you are going in blind. And if you're going in blind, guess what you're using? Hope. That is right. Hope is the belief that the market will change and it will bend to your will. So if you're buying something, the market will go up because you're hoping it will go up. If you're selling something, the market will go down because you're hoping it will go down. But it doesn't work like that. The market's going to do what it wants to do. And this is why hope has no place. And understanding that might sound simple, but if it was that simple, we wouldn't have 90% of people, traders, losing money in the financial markets. We wouldn't have 80% of people quitting in the first 2 years because it's down to hope. They're hoping it doesn't go in the wrong way. And this is why stop losses are important, take profit targets, because it gives you structure, and structure doesn't rely on hope. And allowing your stop loss to hit, allowing your take profits to hit, means you take the hope out of the equation and you're simply letting the market play out as it wants to play out day in and day out. Number two, hope is not a strategy, and we kind of talked about this. And a strategy is having a stop loss and a take profit. Let's just focus on a stop loss because I think this is one of the biggest mistakes that new participants, new traders make to the financial markets. And they go in without a stop loss because they're hoping it goes in the right direction when it is so obvious that it's not going in the direction that they want. So stop loss, the way I think about it, is a stop loss is your guardian angel. A stop loss is your best friend. A stop loss is the best thing you can have. Why? Because one, it allows you to stay in the game. It allows you to stay in the trading, right? Because without it, what happens is you blow your account, the position runs more and more in the wrong direction, and you become emotional, right? Because you hope more and more. You start praying, and like we discussed, the market doesn't listen to your prayers because the market doesn't care about what you do or what you think. And therefore, a stop loss stops that hope. It doesn't just protect your capital. It doesn't just stop you from losing more money. A stop loss stops hope. That's exactly what it does. It's not just a protector on your capital, on your hard-earned money. It's a protector on your emotions because it stops you from hoping. So a stop loss is your guardian angel. A stop loss is your best friend. A stop loss is something that you must hit. And if you're not hitting stops now and again, then you're not doing something right. So that is really important. Hope is not a strategy, and a strategy requires take profits and stop losses. And on the other end of that, a take profit is also as important. Why? Because you are hoping that something goes higher, and therefore you're waiting for more profits, and you're hoping again. So hope works both ways. And look, you're never going to catch the full move. Sometimes you might, but relying on hope to catch it isn't going to work. But guess how you will catch big moves in the market? By having take profits, and then when you can analyze those take profits and stop losses, you can look at what went wrong, reflect, tweak, and then eventually reach bigger take profit targets. But you'll never get there by just hoping. And this is why hope is not a strategy. And this leads me to the third thing, and I think this is more of a common thing nowadays in modern times, and it's hopium. Hopium is something that was termed pretty much after COVID. We had a boom in assets, stocks were flying through the roof, cryptos were flying, everything was going up, property was going up. There was so much money, sloshing about the market, and hopium set in. Hopium is a way to cope through hope. Get it? So you've got hope and cope, you have hopium. And hopium is dangerous, and social media has proliferated, it has spread this hopium effect. And this is where people have a false belief that an asset is just going to surge, right? And typically this happens on the buy side. So what I mean by the buy side here is people who are buying an asset or going long, they're hoping that it surges. And hopium is a way to cope with something when it doesn't go your way. It's kind of related to points 1 and 2, but it's a term that a lot of you might understand, new participants in the market you might have heard of. So hopium is something that you really need to chuck out. Hopium is never going to help you. What is going to help you is replacing hopium with TPs and stop losses and a strategy. That is much better than hopium, because coping has no place in the markets. Hopium has no place in the markets. So this term is something that pretty much embodies or looks at the way a lot of traders that have come into the market after COVID think about trading the financial markets. And look, when you've entered into the markets and you're looking at assets flying through the roof, you know, things going up and up and up, I get it. It could be easily misconstrued that this is normal, but it's not. And this is simply accelerated emotions that humans naturally faced when in the financial markets before social media, before COVID, and it's just been heightened. And I think that hopium is a good thing that describes what has went on. Number 4, sticking with strategy. And this is sticking with risk management. This is sticking with your stop losses, reflecting with things, your technical analysis, fundamentals. Let me explain a little bit about this. Fundamentals are what drives an asset in terms of news events, other things that are correlated to that asset. So for gold, it might be wars, it might be economic uncertainty, it might be tariffs that are going on, it might be some other political instability, right? So these are things that are fundamental drivers of the price of gold, up or down. So if you have relatively safe times, if we have economic certainty, then gold shouldn't go up in that type of environment. In actual fact, it should be a driver of bringing gold prices down. So that's the fundamental way of looking at what drives an asset, right? And I'm talking about gold specifically, but we can talk about stocks, or we can talk about forex pairs, which might be sensitive to interest rates. So there are fundamental things that drive the prices of these assets. So that's the fundamentals. Then sticking to your technicals is looking at price action on a chart and looking at areas of supply and demand. And then you can look at indicators and all these things, but essentially it's looking at supply and demand and trying to pinpoint areas where an asset is oversold or overbought, and then being able to profit from these overbought and oversold conditions. So with that, you can then overlay your strategy, your risk management. And look, none of this is hope. None of this is relying on emotions or hoping the price goes a certain way, because you're basing it on fundamentals, you're looking at technicals, then you're overlaying strategy on top of that. So these are ways to avoid hope, is by sticking to these things. And here's number 5, and this is very important, and I kept this till the end because the other 4 things build up to this. Hope amplifies other negative emotions. Hope amplifies greed. Hope amplifies impatience. Hope amplifies anger. So hope is almost a driver for these other things. And look, all these emotions and mindsets and behaviors of the mind, they are interlinked. We cannot get away from that. But hope is a driving factor of that. And this is why if you can get to the crux of the problem, if you can pinpoint one of the main things that you should be looking at mastering, I believe that's hope. And by mastering that, by trying to negate that, by trying to get rid of it, minimize it, you will help the other things that are a disadvantage to your trading mindset, a disadvantage to your trading strategy. And that is the other things we speak about: greed, fear, patience, or impatience. And so hope is one of the underlying things that must be curbed. Hope is a driver of these other emotions. So it all begins there. It all begins with having a stop loss as your guardian angel, replacing hope with strategy and practical device, not listening or to social media or pandering to hopium, thinking that it's normal for assets to just fly up. And then replacing that will allow you to curb or rein in other emotions too. So with that being said, hope is one of the biggest drivers. And look, if you've not watched episode 1 on greed, episode 2 on patience, episode 3 on fear, episode 4 on practical advice, episode 5 on anger, I would go and watch them, because after watching this video on hope, I can guarantee you that when you go back and watch the other videos, you will see them through another light. It's a bit like when you watch a movie, and when you watch it for the second or third time, you go back and you're like, oh, I picked up things, or there's things that I missed that make more sense. It's the same thing here, because repetition is key. So after you watch this, go back, watch the other episodes, and then when you watch this again, your mindset will be not like the 90% of people I spoke about who fail at trading, or the 80% of people who quit within the first 2 years, but instead you'll be closer to becoming a professional and behaving like a professional and mastering the mindset, the trading psychology. So with that being said, it's your boy GTS. That's another episode in the Mind Mastery. I'll be back again. Let's go.